Hey, welcome, guys. Welcome on. Let's get this going. All right, guys, welcome on. Sorry that I'm a bit late on. I just had some stuff to sort out, so check and see what's going on. So as you're getting on, guys, welcome on board. Welcome, guys. Okay, so we'll start in 1 more minute. Today is an exciting day. Better late than never, right? I make sure that I edit the video a little bit so that it's clean. I think I'll record this one and probably up. Yeah, probably if the signal feed goes a bit funny or something, I'll replace this feed we have here with the actual one. All right, I'm gonna do a recap and then after we'll go from here. Now, this session won't be that long, like probably some of you are expecting, but we will do a few things here so that we can take a look at the price action of what's going on for the day. So hang tight with me, guys. I think for time's sake, I'll start. Yeah, I'll start now. All right, so let's begin, guys. So welcome to the final episode, okay, of this series. Of course, not the last series that I'll be teaching, but a very important one to kind of set the pace of where we're going. So when it comes to the price action of, going over to look at what price is doing, how it's behaving, and things like that, one of the key things to look at, okay, as we spoke about yesterday, is premium and discount pricing. Every asset, okay, every market, every financial market asset has a price, okay? Commodities have a price. So the real game of the market, even though we are looking at candlesticks and we're looking at different structures and price delivery methods, what it really boils down to when it comes to the market really is just one simple thing: price. What is the price of an asset? What is the price of a currency exchange rate, like the euro to the US dollar? What is the price? Is the price a good price to buy or a bad price to buy? Is it a good time to sell one currency for another, or is it a good time to buy that currency? And so when it comes to looking at these models and looking at price action and etc., one of the key things to pay attention to when it comes to the price is this very fact, okay, is how to find out what's going on. Now, intelligent money, as much as we can talk about complex things, and I know we have gone through a few things that are quite complex, or possibly even new to you as well, and never heard of, kind of like out of the box-ish, that's fine. But ideally, what I want to drive out of these teaching sessions is for you to understand what is the market, what is the price delivery mechanisms, what is price really, and what does it represent, what does it mean? Okay, this is the key thing that I want to portray over to you guys. So, I mean, having that foundation here, again, intelligent money is always buying at a discount and selling at a premium to sell to who? Ignorant money. Now, again, as we discussed, smart money or intelligent money versus ignorant or dumb money, okay, is not necessarily just someone that that trades with trend lines and doesn't use all of the fancy terms that we've been using, but ignorant money is also people who are in the market who have a lot of money and not aware of price delivery mechanisms to the degree that they should do, who are not aware of certain pieces of information. So they can be ignorant, because whatever you don't know, you're ignorant to. Okay, so in the market, there are degrees of ignorance, okay, all the way up to no ignorance at all, which is the upper echelon of the market, okay? So depending on the level of knowledge you have when it comes to how the price delivery mechanisms work, okay, controls, you know, how well you fare out in these markets, okay? So now that you have that under your belt, let's continue. So as we were recapping here, the key thing that we were going through is looking at discount pricing and premium pricing. So now what we're going to do is we're going to put everything I've taught from the beginning all together. And I want to spend the time for a few minutes to teach and analyze at the same time, okay? So I'm going to pick a pair at random because I think that's the most cleanest way to teach. If you ever see me pick a pair at random, the reason why I'm doing that all the time is just because I want you guys to all see that what I'm doing is not pre-planned. So I'm going to choose a random pair. Now, if anything, at any time, if you have a pair that you want me to look at, or you put in the comments below, if you put in the comments, what I will do is that tomorrow, when I do the game plan episode 6, then at least it's pretty easy. With game plan episode 6, I can actually spend the time with you guys to go through what you asked for, okay? Some of you may want to look at different pairs, okay? Now, I'm going to go outside of Forex for a minute, and I'm going to choose an index, all right? So let's try the US 30, for example. We're going to spend some time there today, all right? So if I go to US 30 right now, I'll go to standard here. And what I'm going to do, I'm going to start off with the monthly, okay? Now, when we look at the monthly price action of the US 30, remember some of the rules that we want to go for. Now, when you're approaching the chart, there's a few things, of course, you want to look at. Now, in the first lesson, we really went in more detail about price delivery mechanisms, how it works, accumulation, trends, expansion, retracement, reversal, okay? Now, the key thing here is that what we want to look for is, now, the way you want to set up your analysis for institutional trading and then, or institutional price action, and then add your strategy on top of it for entry, is to get the first framework. Now, in my personal opinion, I think the best framework for looking at anything to do with a financial instrument is to work out the pricing, work out whether price is in premium or discount, because that will kind of help to give context to the behavior of the market in as a whole. So there's two things. Now, to do that, now we need to find some swing highs and swing lows. So let's do a quick analysis here. I'm going to zoom in, and I'm going to start from 2020. I mean, we could start all the way from down here, but I think this is a lot more closer to our eyes, so it's easier to work with. Let's just work out the swing highs and swing lows. Now, over here, I'm going to take off the period separators for just a minute. But if we look over here, we have a swing high here because this is a bearish candle. Okay, this is the highest candle where candles either side don't close. Now, some of you say, okay, but what about this one? Because it's red, blue, red. Well, if we look at this properly, the last this candle here, remember the conditions for a swing high is that candles either side of the candle in question, the high in this case, candles, if we were to call this 1, 2, and 3, candles 1 and candles 3 shouldn't be closing above the high of candle 2. If there is the case in your analysis, then this is not a swing high. However, this one is a swing high because if we look at the next 3 candles, 1, 2, and 3, candle 1 over here, okay, and I have to straighten this out. There's a little magnetic tool that makes this thing go bent or follows the highs and attaches it to the candle. So candle 1 and candle 3, we can see that these 2 candles here, the highs don't close above this high. Now, after this high, the price changes direction. Now, it's a little bit weird here. You've been thinking, well, it's a bearish candle, but the price is still going up. Yeah, that can happen. And that's why I said it doesn't matter the actual candle itself in question. It could be a bullish or bearish candle. The concern really is when we're looking at this is the highs and the lows, okay? Highs and the lows, remember that. So this is our situation here. So we can say this is a swing high. So if I keep this here, and I'm going to put the period separators back on now, this high right here is our swing high. Now let's look for a swing low. Okay, swing low, same situation. Over here, this is a swing low, even though it's a bit of an awkward one because the low of the candles here, the low either side doesn't close beneath the lows, which is a good one. So we can start our Fibonacci from here. Now, the reason why we won't start Fibonacci from here, and I'm doing this on purpose for you to see, is because if you were to do this analysis and start fresh from right now, you can see that this lower swing point over here has already closed with the bodies even of the candles strongly beneath this low. So you wouldn't be able to do a Fibonacci from here. You need to find the next swing low down, okay? Now, so far, so good. We can keep the high where it is. We just need to maybe drag this down a little bit. And if we do so, there's another swing low over here, okay? Now, there's also another major swing low over here. Now, for me, I like to go with major moves. And this move, of course, was March 2020 lockdown. It may not be, of course, to you, but it is 2020 lockdown. Massive wick. Okay, now if we go over here and look at what we've got going on, and I'm just going to grab this. If I drag this down here to the end, what do we have? So as soon as we do this, all right, we have the range from 2020 to 2023. Now I'm on the monthly chart, okay? So first of all, you will say to me, well, how are we going to get an entry for the monthly chart? We're not going to use this to get an entry, but what we want to do is frame the price action. So what I'm going to do is, as the session is titled, it's called The Art of Trade Entries. So what I want to do is to spend the time to frame an entry. So number one, when you come into any chart, you want to go for a higher time frame, okay, price, I'll put price action analysis. Let's just put higher time frame analysis of pricing, not price action, pricing, okay? Bit of a difference there. Pricing, what we're talking about here, and I'm going to put the A point here, is going to be number one, our premium and discount pricing analysis, okay? This is the first thing you want to do on a higher time frame, okay? Because the higher time frame controls the theme of the price, the overall direction that the price is trying to achieve, okay? So you want to spend your time there to work out what the price is trying to achieve with a situation of such, which in this case right now would be to have some sort of premium and discount pricing range somewhere that you can work with and etc. Okay, this is the first thing you want to look at, right? So bearing that in mind, that's your first thing you want to do. Now, in terms of suggestions for timeframes to do this, all right, I'm going to do it like this. I would say when you're running it, okay, depending on the style of trading, I'll say monthly. Let's put this here. So I'll put I here. Timeframes, the best timeframes to do this will be the monthly time frame. Let's put this in purple. Yeah. Monthly time frame will be great to do this with. And I would say also the weekly time frame, right? And thirdly would be the daily time frame. Now, what are the different purposes when you're doing these different time frames? Because they do have meanings. Now, when you're looking at the monthly time frame, what you're really looking at is going to be the theme of price direction. And I'll say pricing and direction over the long term, okay, picture, okay, or the theme. Okay, when you're looking at the weekly, because it's a smaller time frame, you will still get a few years within your frame of reference, but not as much as the monthly. So what you're looking at here is the shorter, say, theme of pricing and direction for the year, okay, for the year, okay. With this, for multiple years. Now, when people do analysis like this from institutions and they look at price or price projections, they have their 5-year, 10-year, 20-year, 30-year, 50-year, 100-year projections. Maybe not 100, but maximum 50, 30 to 50 is the largest they will go, okay? And the reason is, and this is more of a fundamental reason, is that financial economies go through different types of cycles. Now, a really good teacher of this is someone called Ray Dalio, who teaches about cycles in the market. And we have different debt, inflation, deflation cycles that happen continuously in our economy. We've had it for a long time, especially since the beginning of the Federal Reserve in 1913, okay, for many reasons. So whenever we're looking at this, or whenever the monthly time frame is looked at, it's for this purpose, because there are themes of price across several time frames that are important for reference to look at. Okay, so when the time frame, even though the monthly time frame, of course, is a massive time frame, there is reason for the price to do exactly, you know, what it's doing. So if we take over here and see what we got going on, let's go over and see what happens when we look at the price on the daily time frame. So I'll take this and let's go over to the daily. Now, the daily time frame, especially if you're a day trader or intraday trader, is where you really want to be hitting at. Now, I want to put this as a preface that you don't need to use a weekly or monthly to be a good trader, okay? But when you're looking at different time frames of reference, all right, you want to keep, you know, note of these ranges so that you can understand what's going on. So free pricing direction for, okay, intra-month to 1 year, okay? This is what you use the daily for, okay? You can also use it for intraday as well, but in terms of having a broad scale time frame. Now, I consider the daily time frame and above to the monthly to be the what I call higher time frames. And I consider the H4, I mean, the H4 is in the middle. You can call the H4 part of the higher time frame as well. Okay, but primarily daily, weekly, and monthly, these are the higher time frame analysis. Okay. Now, lower time frame analysis here. So I'm going to go for part 2. So if I go over here to lower time frame analysis, so no lower time frame. So lower time frame analysis for pricing, not necessarily price action, okay, is, let's start off with the H1, okay? So H1 is going to be for day trading, okay? Theme of pricing and direction for the day to 5 days, okay? So from 1 to 5 days, which is about 1 trading week, okay? All right, then you've got the next time frame here, which is, I would say, the M30. And what I would say is that when it gets down to entries, I usually prefer to have entries from the M15 and below. So I would say that H1 to M30 would really be the time frame to use. So what I'll do, I'm actually going to put the M30 and the H1 together, okay? Because there are times where the candlesticks are big enough for them to be both in both directions. So I'll put this here like this, all right? Now, the final time frame, so from M15 down to the M1. Now, I know that some people decide to enter on the second chart, like you can do that with TradingView. If you have the Pro package, you can actually get 5-second candlesticks and etc. But from the M1 to the M15, really what you're looking for is the theme of direction for trade entry, okay? So for trade entry within an hour, or less than an hour, okay? As in less than an hour's time frame of watching, you're going to be looking for something around that time, right? So now that you have all of this context in mind, so when it comes to pricing, remember there's 3 things that you look for, and I'm doing a bit of a recap here about pricing, okay? So pricing of assets, financial assets. So if I go for pricing from here, there's 3 things that we're looking for when it comes to pricing that we can go and look at. So number 1 is premium pricing. So premium pricing is where institutional money will not be looking to take any trades at all, or looking to take clear or open up any of their entries unless they're trying to exit. Usually where premium pricing starts for retail is where institutional money or intelligent money will be looking to come out from or get you to buy into so that they can use you as exit liquidity and stuff. All right. So now we've got number 2, which will be discount pricing. Okay, discount pricing. So what I'll do here is that we're looking at levels above the 50% or Okay, so levels above 50%. So the 50% level of 0.50 is the Fibonacci level tool that you can use to get your equilibrium point. Okay, and then we have premium pricing, which is levels below 50%. And then we have the final thing, which is number 3, and that's going to be, let me just put this here. So then number 3 would be true market. Now, I don't like to use true because even that price is probably fake anyway. So I'm going to say fair, okay, or true market value pricing, which is exactly the 50% level. So when the market is at an equilibrium, which is the term, that equilibrium point, okay, of 50% is where pricing has been deemed to be the actual fair market value for an asset. Okay, so if you're in a range, you're looking at an expansion or you're looking at a trend, same terminal, different terminology, but same word or same meaning anyway. If you're looking at equilibrium, for example, in this market here on the US 30, the equilibrium of fair market value, according to this range of 3 years, is 27,620.18. Okay, that's really the range. And notice here that in this range, there is an order block. Okay. So this order block range that we have going along here is a range that we can look at to see what price will do when it reaches here. Okay. So let's start. So now that you have these things here, so higher time frame analysis, lower time frame pricing analysis, and then you have pricing of financial assets, let's go over to the next part here and see how we can use this. So putting the things together that I've done from the teaching over the last, 3 days, let's put this here. Okay. So first of all, when it comes to the Fibonacci levels, if you don't have them, please take a screenshot of these now, guys, so that I can. So we've got 50%, 62. Okay. We have the 75% level, which is optimal trade entry. And again, anything above optimal trade entry is just a deeper discount in price. Okay. 78.9, 86. Now, 2 levels are retail levels, and I've left them behind so that we can see how premium pricing is used to entice, okay, people who use the Fibonacci. And I don't want to just limit it to retail because not only retail traders use it. Okay, well, people with small hedge funds, which is less than 100 million, do use Fibonacci tools. Robots use Fibonacci tools. So you can't really just call it retail only. Okay. All right. So let's do this anyway. So if I draw this demand zone over here like this, let's put this right here. Okay, so having that in mind now, let's do an analysis on the US 30. So first things first, we can see where the 50% level is. And at the moment, looking at this trend is definitely heavily bearish. Now, adding in another piece of price delivery mechanism is a term called retracement. Now, there's 2 parts to retracement that I want to go through. Okay, and that is reversal and retracement. These are the last 2 parts, because you're wondering, where are the last 2 parts of what we're talking about when it comes to the price delivery mechanism? So here they are. So the last 2 parts is retracement and reversal. Okay. Now, reversal is a very interesting one because reversal is a trigger for change in direction. Okay. So swing high and swing low points are the markers of a reversal. And reversal, of course, the price action can be a profitable one because if you can identify when the price is going to change direction, then you can make money from taking the opposite side of a previous trend, right? So if you could notice, for example, over here, this is a bullish trend. Now, in theory or textbook wise, whenever we're looking at trends, they usually have 4 phases to them. Okay, and these 4 phases are swing points, and we call them A, B, C, and D. So here's A, here's B, here's C, okay, and here is D. All right, and this is for a bullish trend. So I'm going to write this here, and I'm just going to put underneath. Here we have a bullish trend. Okay, bullish trend. Okay. So this is a bullish trend. Now the bearish trend is the opposite. The A starts off from the higher point here, and the price, because the price is bearish, the price is going down. So we start from here, A, then we have B, C, and D. All right. And that is going to be a bearish trend. Now, for visual teaching's sake, I'm going to change the bearish trend to red very quickly so that you guys can see what we have. So before we actually get into the art of entries, we need to kind of understand the price structure of what's going on. So let me just make this red quickly. I'll use a red that's easier in the eyes. Just go for this here. All right, so let's go over to here. All right, I don't know where okay, here we go. I've got chocolate, but I had Indian red. That's the color I'm looking for. Indian red. There you go. Now, I don't know if I got the right color, but I think you guys get the picture. If not, just do it the other way. Let's drag this on, copy and paste. All right, so here's a bearish trend, and then we have the bullish trend, okay? These are the two trends that you have in the market. Now, I'm going to give you some important facts for you to know about trends, okay? Another term for them are expansions, but expansions in terms of price delivery come after an accumulation. So I'm calling them trends for now, but trends are birthed from accumulation, as we discussed. So when the price expands out of a range, we call that a trend, okay? So the first thing to remember is that the A to B, okay, and let's put this here, C to D movements of a trend are called thrusts, okay? Thrusts, okay? So what the trend direction that we're looking for, and I'm just going to put this here 12 in blue. So the first thing to remember when it comes to looking at trends, now when we're mapping our premium and discount pricing to understand institutional minds in what we're doing, the first thing that we need to, of course, adhere to and remember is going to be this aspect here, which is to understand what the price is doing in a trend. Now, I wouldn't recommend to use this tool within an accumulation unless you're looking for an entry and the price is breaking out of it. But if not, you wouldn't want to use this because the price will be bouncing from one extreme to the other almost. So you wouldn't really be able to get a very clear reading of what's going on. Okay, but when it looks like this and we have trends like are very clearly in a direction, you don't need to be very deeply knowledgeable in trading to know that the price seems to be going upwards, right? Because of the graphical demonstration of the price, right? So A to B movements and C to D movements are always called the thrust. So whether you're bullish or bearish, the A to B movement here, which is a bullish direction, C to D, which is the bullish direction or long, sometimes it's called, is always on the upside. Bearish trend, which is the price is selling off, the A to B and C to D movements are always thrusts. But there's this part here, which I'm going to highlight over here and over here, which are these moments in time where the price is going away from the trend. It seems like the price is going the other way from the trend, okay? And this is what we call a retracement, okay? Retracement. So the final thing I want to go through here for now is that the C to D movements, A to B movements are thrust, but then the B to C in every type of trend, all right, are called the retracements. So as the name entails, a retracement means where you're retracing your steps. Now, of course, if I use a practical example, you might go all the way back to where you started from, okay? In which term we'll call that a full reversal, okay? But a retracement is, I can put it this way, is a degree of the price reversing, okay? If you want to think of it this way, because the price is reversing away from the actual direction of the market, okay? If you didn't see the C to D movement in this bullish trend, and you just looked at A to B and then you saw the price dropping, the price is reversing away from where it started off from, okay, right? We can all agree on that. So bearing that in mind, in terms of looking at trends, you can see that the market or the price action of the market of a reversal and a retracement are very similar. Okay, and this is why I want to try and break down the definition here so that you guys can get the difference of what's going on. So anyway, this is what we call a retracement. Now, these retracements need a trigger, okay, to move. And these triggers, okay, for retracements are what trigger a reversal, okay? So if you could find out the triggers, which you already know what they are by now because they're the swing high and swing low points, if you can identify those, then you'll be able to find out when the price is going to change from one direction to another. Now, you need liquidity. So if we add the next thing, okay, on top of this, is for every swing low, if the demand zone here, so if I put this right here like this, and I draw demand zone, so every time there's a demand zone and a swing low, then that means the price will be buying. And if I was to give a quick demonstration of this, okay, just a simple one somewhere down here. So we have a demand zone over here. Okay, I'm just using this chart at random, right over here. And let's see what happened. Well, if we look at this very carefully, and I can zoom in, it will ruin the drawing for a minute, guys. But once I zoom back out, it will be okay. So if it breaks apart, don't worry. This is how MetaTrader is. So if we go over here, let's look at this demand zone. So over here, we have a demand zone, right? There's a bullish trend, last bullish trend, and this is the last bearish candle before the price changes direction. Bam, price is going long. Now notice when the price goes up here, it comes back down, and notice we have this specific candle here, and I'm going to highlight it for you quickly. This candle right over here, maybe highlight isn't the best, let's use an arrow. This candle over here, notice what it is. It's a swing low because we've got the low over this candle here. This is another low. Now the red is pretty faint, or chocolate color is pretty faint. So let's go back to blue. Yeah. So if we look at here, we've got one low here, another low here. This is the low and another one. Now, if we ask ourselves, is this a swing low? Well, yes, it is, because bearing in mind what we just looked at just a moment ago, okay, the low of this candle is definitely not lower than this candle, and neither is this one, okay? And now the candles on either side of this low don't close, and after the price goes down here, it changes direction to the bullish direction. And if we zoom back out, in retrospect, if you actually bought down here and never closed, you would have all this money for yourself, right? And what did we look at? We looked at two things. So we looked at first order block, which is demand, which is the liquidity on the market order book. Remember, as we said, that supports, you know, this price action to go for a bullish direction. Then we had the swing low form. So if we put those two things together, just those simple two things for today, and say every time we see a swing low and we see a demand or a supply zone, or we see a supply zone and a swing high, we want to sell. Okay, so let me write that down. Say art of entry rules. So if we said right here, okay, every time we want to buy, the conditions for now, apart from looking at the Fibonacci, okay, so if it's a bullish trend, so let's put here for buy, we will say every time price forms a swing low plus or into a demand order block, we buy. It's very simple, okay? So every time we see that, just that two signature there, and this is not looking just at this now, because we could have done this again. If I draw the next demand zone here, we have many swing lows. We have one here, all right? One here, then the price goes up here, then it does another one down here, and then the price goes up. So you would have had multiple opportunities to buy in this same region, right? Okay, so now that you know that, okay, what would you do for the sell? Well, the sell will be the same principle, but just in the opposite direction. Instead of looking at the swing high or swing low, excuse me, we are going to be looking at the swing high. So every time price forms a swing high into a supply order block, which you understand by now how to find, okay, the last bullish candle before the price changes direction, then what we're going to do with that is we're going to sell, okay? So let's try that out and see how that works. So let's see if there's any track record of this working right now, because that's an important thing to look at. So I'm just going to go from right here. Let's look at the most recent price action, see what's happened. So here we have a demand zone. For those of you watching, you should all agree with me that this is a demand zone. This is a bearish trend. The last bearish candle before the price changes direction, boom, the price goes long. Now notice what the price does. It pushes up here, and then we have the magic swing low. So the candle on either side, so candle 1 over here, candle number 3, the price doesn't close beneath this low. And then after this low is formed, the price changes direction and is currently higher in price than where it closed before. So it's at least a few pips higher right here. So if you were to take this simple trade, you would have entered here and you would have made money up here at least, and you would have still been in profit now. Okay, pretty simple, right? Okay, now where do we add the institutional price action now? Well, if we can find out what the trend direction is, and to do that, of course, I need to zoom out one more time and put this back to normal. If we can find out where institutional money is, or where the fair market value is in this case, then we can make use of that. So if I was to take this small little trend over here from the first bullish run here, and I'm going to have to zoom in again, which will break this. All right. In fact, you know what I'll even do? I'll open up another US 30 for you guys right here, and I'm going to go over this part right here. So standard and monthly. Okay, so if we do these two things together as a combination, what do we get? Now, zooming in again, this is our framework here on the monthly. This is our main framework that we're looking at. Now, if we were to just take from this range to this range, this last bullish movement here, let's see where the price kind of bounced over here. Let's see where this swing low again came from. Now, remember again, guys, when I'm trading this, I'm actually not in any form or shape actually planning this. This is actually not a planned pair that I'm looked at. I don't really trade the US 30 hardly ever. So, and that's just me. I'm not an indices trader like I know some other people are, but no, that's not really for me. All right. So again, let's look at the US 30 and pay attention to what's happening. So if I drag this over here, like so, okay, then let's look at where the price bounced to. So first of all, now usually I'll give you a very clue here. Whenever you identify correctly a trend, finding where supply and demand is not so difficult, because remember, at the swing low, demand liquidity forms because the price has to change direction. At a swing high, supply liquidity will form because the price needs to change direction to go short. So usually you can actually map out these ranges, and I'm going to show you a demonstration. If I draw this area here, demand, all right, swing lows over here. So let's point to it. This is the swing low. Swing low. Okay. So wherever the swing low is, you'll find demand around that area. Okay. And wherever the swing high is, you always find supply around that area. So if I go over here, swing high, this is a swing high right here, which is the range of our analysis here. And then let's go over here. If I do this and I go over to blue, if we look one candle back, we see the last bullish candle before the price really changed direction to kind of sell down before going here. It's right over here. So immediately we actually have a supply and demand range you can operate in, which is really fantastic. Now, the great thing is, remember what I said about time frame? Price is fractal. So that means on every cycle of time frame, you can actually scale down and what I call cage the price into different areas. So what we could do, let's say, for example, now you don't have to do exactly like this. You could keep this supply zone area here and remember that, okay, on the higher time frame, and now the key is that the higher the time frame, the more determination, I would say deterministic control. I always try to slow down what I'm saying because I want to make sure that you get it, but the more deterministic control and the price has over a certain, pair. So for example, on the monthly time frame, the monthly time frame will be the supreme deterministic factor in terms of supply and demand range on what the price is doing. So you could do this in another way. Apart from the fact that the price is above equilibrium, which means that the prices are not premium for buying, but it will be premium for selling, okay? Remember this, guys. If it's premium for something, it's discount for another side of the market. So just to, before I continue what I'm going to say, if the price is in discount for buying, then that means it's going to be premium price for selling. It's the bad price to sell, okay? Because for you, there's always that war going on. On the other side, if the price is in a very good discount to sell or to get to sell something, then it will be too premium to buy. And at the moment, this is a bullish trend. So whenever the price is above equilibrium, it will be very bad to buy at this price range above equilibrium, but really good to sell, right? So if we go back over here, this is our monthly supply zone range. If I go down to the D1 time frame, what you can actually say is that anytime the price is in this range, we know that the overall liquidity will be more bearish than bullish. And if you look at the price here, the stronger side of the market is clearly there's a lot more bearish trends just from I value. So if you're thinking in the back of your mind, how do I use this? Well, if the theme of price in the short term anyway is to sell because you're inside of the range of supply, well, then you might want to pay attention and focus on supply trades or sell trades within supply zones, because the liquidity power in the price on the higher time frame will trickle down into the lower time frames and give you some nice sales, okay? Like for example, up here, the price formed a swing high, okay? And then if I was to draw this, we have a very big supply zone all the way across here. And anytime we see that, guys, if I make this slightly smaller for the sake of teaching, anytime the price was in anywhere within this region, we had some really nice sales going. So in fact, by going down to the D1, you could have had a sell down here. You could have had another one here and then a buy right over here at equilibrium. Right back here, as soon as the price gets here, price sold up again. Okay, so I hope you guys see that picture. Okay, so now that we can see this picture, and I hope you guys can see this picture, I'm saying we because we're in this together. Now that the price is doing that, let's see what we can do with this. So now that we have this method in mind, what would we do? Well, one thing about zooming down to lower timeframes is that it does give you the ability to see more clearly what's going on. Okay, so I'll leave my swing low over here. I'll leave the swing high right over here. And let's look at what the price is doing now. For the sake of teaching, I'm going to take off this supply and demand zone from the monthly time frame. Now, how you would do it, which is what you probably see me do in my teachings, is that if I'm using a higher time frame supply and demand zone, I'll write it somewhere. Like if I just undo what I've just done, in this case, I would have said something like, and over here, I would make a note. And this is how you analyze. I'll say, okay, this is my monthly supply zone, right? And then from the monthly supply zone right over here, then what I would do is I would go over and say, this is my monthly demand zone. So as I'm going down in time frame, I have a reference point to really understand why I have this massive color just sticking around over here. What is this? Okay, at least you know what it is. Okay, so when you switch from one time frame to another, you kind of have a reference point to understand what you're dealing with. Okay, so now that we're on this time frame, from the monthly view right now, let's ask ourselves a question. So in this teaching part right here, remember what we said about trends. Now, for a trend to be complete in cycle, there needs to be a retracement, okay? At least below the 50% level. And if we take a look just from this small range over here that we've drawn over here on the monthly, has the price really had its retracement point since it made this A to B? Now I'm going to add this point over here and call this A, right? And I'm going to call this B, all right, over here. Now I'm going to show you why I say to you that even when it comes to things that seem to be a financial crash or crisis, it's all pre-planned already, okay? And I'll show you why in a moment. But let's just focus here. So if we look at this, we have A and B. Now, notice that in our analysis, when we look at the price action here, okay, we haven't had a chance to even come back to equilibrium right now. And we have an order block sitting here, which is a very strong one because demand liquidity was derived from this area right here, right? Now, if we add all of these metrics together, then what we should really be able to ascertain to already with this analysis is that at the moment, price is still in premium, number one. Number two, the price hasn't returned to discount even once yet, okay? Because when the price formed this trend from this range, this is a reversal or retracement right now, or the reversal that triggered the retracement is another way to say it, hasn't brought us back to at least fair market value, which is at this equilibrium range right here, okay? So at least we should be looking, and if you were to do some markings, and this is how you would analyze, is just to draw a line simple here and say, you know what, I should be expecting, or we should be expecting the price at some point to at least get back to the equilibrium level. And if possible, maybe even discount. Now, why would we say maybe in discount? Well, because of course, intelligent money has the money to control the market. Another thing to look at is that we have a demand zone order block here, which is the last candle before the bullish trend. And plus, our optimal trade entry levels, OTE and 78.9, are inside the bottom range of this zone. So if we were to do another thing, we could say that scenario 1, which is how you see me analyze, could be here. Scenario 2 could be the price drops even further and gives us a deeper sell, right? And this is how you analyze the art of entry. You're framing out the supply and demand. You're matching it up with the fair pricing levels, because the market is about pricing, no matter what financial asset it is or asset class. It's about looking at pricing. So if we were to say fair market value for buying, at the moment, the price of this asset, okay, is above fair market value. So there needs to be some way. Now, people who are holding on to this asset in any form of the US 30, the US 30 is the Dow Jones, which is a weighted mean average of the top 30 US stocks in the US economy, on the US stock market, basically. So those top 30 stocks, Apple and etc., they add all of the prices of those different assets together, divided by 30, and is weighted depending on their market cap and etc. And that gives the price of what we're looking at here, the US 30. So now that you understand that, okay, let's look again and say, okay, well, in this context, the fair market value is a lot more down to below 30,000 at the 27 mark. So we should be expecting somewhere in the future, the near future, for the price to be at least returning to here as a start. May not get back to discount, we don't know that, but at least the price should be doing that, okay? So this is your first thing. So what we would say is that you should be looking for some sales. Is there any way that we can find a sell? Is there any opportunity here where we can find a sell, right? That's what you would do. So what would you say in this case to do? Now, the next thing to do would be to come down to this time frame. Another thing that you can do as well, and I'm going to bring up this chart over here to give an example of it. So if I go over here to this chart and let's go to the monthly time frame here. At standard, what you can do, let's just put this line here, is to look at the most recent swing. Again, it might not be a little bit clear, but if I just do this, you recognize that this is the A swing and this is the B. So the next step that you can do is to start your analysis from the most recent swing. Because remember, from A to B is what? I'm hoping that in your brain you said retracement. So A to B is retracement. So let's put A over here. All right, and then over here is B. So another way that you can say this, and I'm saying this in multiple ways so that when you watch this video back as many times as you do, guys, you can understand multiple ways to take on analysis on board here, right? So with that in mind, what would you do? Well, you would say, okay, from A to B, we've had a thrust. It's pretty clear we've had a thrust. I'm going to put this here. This is our thrust, okay? Now, the B part is what's currently our main trend that we've had for, in this case, from 2022 until now. So what we can say is that we can do an analysis to look at the retracement. Again, if I go back to the model here, right over here, we're in a bullish trend, but we're at this point right here. Right here, we're in a bullish trend, but we're at the B point. Now, in every retracement, what's the price going to do? The opposite of the overall trend. In this case, the price is definitely clearly bullish, but we should be looking for the price to go from a B back down to a C. Now, let me show you why this will always happen, okay? Now, one of the most trying times in history was COVID-19. And if I take this swing low and I start there and go all the way up to this point, close this. Now, look at what happened. We had a very prolonged bullish run from 2016 until 2020. And look at what happened in 2020. This massive crash that we had in the price, where did it fall down to? Look at the lowest point of the wick where it got to. Now, some of you who are the students of my teacher by now, you would have known that, look, it fell right here into a demand order block range. Okay, in this case, it's a supply flip zone. Okay, there's a supply zone here, the price broke above, it returned and came back to the other side. And again, what was the achievement of this massive crash that seemed to be out of nowhere? We had an A, we had a B, and then we had what? A C point. And where did the price fall to? Optimal trade entry. So even with financial crashes, those are all priced into the market very well. Now, if you captured this market crash right here and you bought, you'd have been a very happy person because you would have made double your investment, okay? And so this is important to understand when you're looking at price action of assets. Pricing is the key foundation that you need, okay? Now, the conspiracy theory stuff around COVID, I'm not going to go through, but let the price tell you for yourself what you think about that, okay? I won't say anything more, all right? Now, I've shown you this works on any time frame and any event in history because we're looking at the price, and let's move forward and look at where we are. So again, the phase that we're in right now, and I'm just going to draw the little trend line on here to help you guys remember what I'm talking about. If we go along with where we are right now, okay, here's A, here's B, all right, and then we have C over here, like so, and then we have D. So right now we're in the retracement phase, which means for the short term, in the bigger term view of this trend direction, which is bullish, there should be some sort of seller. So what would we do? In this case, and this is what I would do, we're still analyzing the US 30, is to take the high of the B point, all right, the high of the retracement point or the start of the retracement. So I'm going to put here in brackets, beginning of retracement, right? This is the beginning of the retracement point. And at the moment, for now, this is the end. Now, this is where you have to start to practice and, of course, use both Fibonacci's to help you to understand what I'm about to say next, okay? Now, this is the beginning of the retracement, but down here is not the end of the trend, okay? And the reason we know that, and this is why doing a top-down analysis, which is what I call it, is important to do, all right? This is the end of the trend, okay? But this is not B, okay? This is not B. The reason why it's not B is because remember what I said about higher time frames. If I take this point to this point here, equilibrium, and I'm just going to do a quick line so that I don't confuse with the amount of equilibriums and numbers you see. According to the monthly chart and to the weekly chart, in this case, the equilibrium point is around the 27 price mark. Right here, the low of 2022 is around 28. So equilibrium, or the 50% level, or the C point, which we can see a price shooting up again, is further down than this low, okay? It's further down than this low, okay? Now, another thing which will help you to figure out what you want to do is, of course, putting these Fibonacci tools together. If I put this up here now, for example, and put this back over here, you can keep both of these on if you can keep track of the numbers. Usually I try to leave a line to represent levels that I need and I just delete it. But just having that in mind alone, you should understand that with this trend, if it's going to continue, at minimum, there should be some sort of selling situation going on down to here or to this next order block for now, all right? So now that we have that framed into our minds, how do we analyze this even further? Well, our little strategy here, very simple strategy to go for. If we're looking for a buy, every time the price forms a swing low into a demand block or the block we buy, every time the price forms a swing high into a supply order block, we're going to sell. As simple as it gets, okay? Really as simple as it gets, okay? All right, so with all of this information in mind, and I just want to kind of put this out there. What do we do? Well, let's trace the price and look for supply and demand on just using this trend area here for now. So starting from top to bottom with our analysis, we're on the D1. Let's take the supply zones here first. So we're in the selling side. So usually for me, when I'm on the selling side of the market, I start off with supply before demand. So we have one supply zone here. Okay, that's the first one. All right, we have another supply zone over here. Okay, we have another supply zone over here, okay? And we have another one inside of here, which is this small one right here, okay? Now, because we put the same color over twice, it will make it blue. Let me just try and make it another color. Here we go, all right? Maybe that doesn't stand out so much, so let me try something else. Let's try this. Okay, seems like all of these colors want to keep things dark. Let's try yellow. All right, I guess that will do. It's a bit faint, but it will do. So anyway, what do we have now? So currently, supply is within this area, right? Now, what has the price done? Well, you can see over here with this wick, or maybe you can't unless I zoom in. If I was to reorder the Fibonacci, make sure I've got it right here from top to bottom. Have a look at this, guys. Take a look. So if we take a look over here, look at what happened with this candle. Seems like for no strange reason, the price wicked over to where? Optimal trade entry. And since that point, it's been selling. So what we want to do is to find out where supply is next, or the next supply zone is happening. And we want to also sell, okay? So far in the weekly, the most apparent area of selling is here. And I want to take a note of this. So usually what I would do in this analysis is I'll look at the first 3 candles, or 4 candles here, and look back here. And if I do that, this is 3 weeks worth of price action. And then what I'm going to do in this case, I'm going to go over to insert or view, market window. I'm going to go over here and we're going to go down to the next time frame, okay, to the weekly. So now that we have that in our mind, we should be set by now to know that the price should be giving us some sort of buy, right? Some sort of buy trade should be really what we're looking for at the moment. So let's take this area. I'm going to draw the Fibonacci range already over this range here. And what we're going to do now is we're going to try to go down as low as we can and find a trade, okay? So look at the D1 here. Now, sometimes when the D1 is too squashed, and I did this part like so that you can see this right now, I go down to the next time frame. So remember when I was saying that the H4 time frame can be considered lower time frame or higher. This is one reason why I would use the H4 instead of the D1, because you can see the D1 is still a bit squashed. It's not really easy to see what's going on. We kind of know that there's a sell going on, but at the same time, we need to see a bit more clearly so we know what to do. Okay, so if we start with our ranges, this time I'm going to start with point A, B, C, and D. So here's A. All right, here's A over here. And here is B right over here. Now, remember, again, our bearish trend. What does a bearish trend look like? It has the thrust, it has the retracement, right? So A, B, C, D should look like this. Let's go over here. So here's A, all right? And then over here would be B. All right, guys, and then this would be C, which will be our point now. So you notice that really in every single trend, the C point is a major key because that's going to be the next trend that you want to capture. And as a trader, most of the time, you may not catch the A to B initial movement. But what you want to do is that the next movement coming on in the cycle, you want to be in. Now, just as a preface here, to add some more depth to what a trend looks like, if the trend continues in the next direction, the question would be, and I've had it before, you shouldn't be upset if you feel dumb if you're about to say or you're thinking of what I'm about to say. The next trend is not going to be E and then F, okay? It stays in this 4-cycle pattern, and we just move the letters around. So what happens in a bearish trend here, if we have another retracement again somewhere, and then after the price goes down short, it wouldn't be E or F, C becomes A, the new A, and D becomes the new B. So we basically do what I call musical chairs. So C would be here, A would be here, D would be here, and B would be over here. And we continue the cycle. Now, in more complex analysis, what people may do, and just to prepare you for the real world here in people's analysis, is that they may leave the A, B, C, D on, and what they'll do on top is they'll call it A1. So they'll say A2 with a lowercase to mean the second A in the trend, and they'll put down here, they'll put B2 to represent the second B in the swing, B2, and etc. So then they won't put a new C here, they'll leave it as it is and call this C2, okay? And then finally, they'll have over here something like D2, okay? And then so I'm guessing you'll see the picture now. So that means the next one will be C3, A3, B3, D3, and etc. Okay, but for complexity reasons, I'd rather just keep it as simple as possible, okay? And just focus on the trend here. So now what are we looking for? Now, we know that at the top right here, not only is this our smaller A, but this is also the beginning of the retracement. This is still the area of the beginning of the retracement. And sometimes what I like to do is that on the weekly or wherever I'm looking, I'll just leave a little something here, and then I'll leave something here similar to tell me that this is the beginning of the most recent retracement, okay? Sometimes I do that just to put that out there. But anyway, now that you have this in mind, what do you want to do? Well, we have A, we have B, we need to be looking for C. Now, surprise, surprise, if we look at what's going on right now, we have this very strong bullish candle on the H4 time frame. All right, equilibrium is over here. Now, because we're selling, one thing I'll always advise for you to do is that wherever equilibrium is when you're analyzing, always check to find out what order blocks are around that area. And if you do so, you'll find that there's a very big supply zone right over here, which is the price is entering as we speak. Okay, now this might actually turn into a trade signal for something, so let's pay attention. Now, here's where it gets a little bit interesting, okay? When you're looking for an entry, we're looking for a retracement of C, all right? In order for the money that causes the market to move, so why are we always looking at discount and premium? In this case right here, below 50% is going to be our premium price, right? This is premium pricing right over here. So let's put this here, premium pricing. Above 50%, now just start over here. This is discount pricing, right? So over here, let's put this pink. Let's take this over. All right, so this is premium. Premium pricing, right? And then over here, this is discount pricing. Right? So if we have these two things, premium and discount pricing over here, and then we have our fair value, which is 50%. So fair or fair value. So this is where the price is approaching to. So you can see that for now that you guys have this understanding, you understand why seemingly for no reason, the price is pushing very, very fast near the end of the market close, because remember the market, for me anyway, in the UK shuts at 10 p.m. UK time. But no matter where you are in the world, the market day is about to close in an hour and 10 minutes. But for no reason, seemingly, the price is just pushing so strongly towards the equilibrium point, which you know what's going to happen here. So another way to also see the equilibrium would be like a deciding ground. The equilibrium point is where the price is a deciding ground. The parties involved that have the money to control the market are making their decision. Now, what are they making a decision on? Remember, the reason why we look at OTE or 62 is because we want to see where the money that actually can move the market, or the hands that have the money to move the market, are ready to buy and sell. And remember the concept of big fish, little fish. We don't have the money to move the market. No retail trader has in their possession the amount of money that can cause the Forex market to move. But there are realms of money that do have that ability to do so, okay? So with those kind of groups of people, what are we trying to do there? Well, what we're trying to achieve by doing such a thing is to get ourselves in a position where, number one, when they're ready to sell, because anywhere in this area of discount, okay, would be the best place or would be nice places for them to place their sell positions, right? And anywhere that's in premium, they wouldn't be looking to sell yet. The price will be pushing up before they make a sell, okay? So when the price gets to fair market value, then what we're going to do is we want to wait to see how the price behaves. So right now, this is actually becoming a trade signal, and we're putting all the things we learned together, all right? Now, what do we add on top of this? So now that we've got to this point, and since we started talking, look at how strongly the price is moving near the end of the day, all right? Just, it seems for no reason, but there is definitely a reason. If you look across even to the left on the hourly time frame, there's no demand zone really to the left that pushed the price to go long, but all of a sudden it just seems to want to go up this way. So you go figure and think about why and what's going on. Market manipulation or market monopoly. All right. So anyway, what we want to do now with our trade, using what we've just learned here, is we want to find our C point. Okay. Because when we find the C point, or we find the discount price points, or we find the order blocks, okay, where in this case, the price will be in discount, plus you have an order block for selling, this is where we're going to look for a trade. Now, looking to the left here, all right, this is a little bit more of a tricky one to find, so I'm going to help you out here, guys. Over here to the left, we have a demand zone, okay? And at first glance, it doesn't look like anything important, but I'm going to break down what's going on here. So if you look at this demand zone here, the liquidity that came from demand here is what gave us our A point right here. And then the price dropped down for B, okay? Now notice that when the price closed beneath here, it was a demand zone. Price spiked into here once for a sell, spiked into the second time, third time, gave us another sell, spiked in here a fourth time and gave us an even deeper sell, right? So this area over here is what we would call a demand flip zone. All right, so I'm going to put here demand flip zone. Okay, so this is a demand flip zone, this area here. The price was a demand zone, but it's been used as a supply zone, right? Now, what do we do next? So after we do all of this, okay, the next thing we want to say is that, okay, we'll draw our lines and say, okay, if the price gets here, for example, above the market value, and we see a swing high, right? Remember, if the price does a swing high within supply, we're going to look for a sell. This will be our scenario one, and we're going to look for a sell trade, right? Now, are there any more order blocks here? Yes, there are. Now, it's a little bit difficult to see, and I'm glad I used a difficult chart to see so that you can get the hang of how to do this. Remember, when we're looking at trends, and we look over here, look, there's a sell here. Let's trace where the sell came from. Now, you can see here we have two candlesticks which are bullish, and for the sake of this color that is blocking the way, I'm going to pull this out of the way and just zoom in a little bit. Now, when I zoom in here, do you see that we have two blue candles and then a massive sell? Now, remember what I said here, the last bullish candle is more wick than body. So you use both candlesticks here. And I think this is a great demonstration of when you would use it to represent supply liquidity. So I'm going to pull this back now, zoom out over here. And then what we're going to do is I'm going to draw this over here, and let's drag this all the way to the end to represent supply liquidity. So we have our discount pricing, we have our premium pricing, we have a demand flip zone here. And then number two, as a second scenario now, which is deeper discount, if the price can go there, we have a supply zone. Right? So now that we have this supply zone here, okay, what do we look for? Well, in this case, we're at fair market value at the moment. What we would need to do for a second scenario is we're going to look to see if price closes above equilibrium. Now, this is the part that I'm sure many questions will be on. How do we know if the market is not going to bounce at equilibrium and go back down again? Body closes. So now I want to introduce to you in very simple terms how to understand when and where to use this. Now, on the same time frame we're on the H4, and let me just put this and take it off the background here. So let's go here. Blue. Yeah. Blue. Here you go. From that point over here, I'll give you a very simple rule. Anytime, okay, and this is a key here. Anytime on the time frame, and I want to put this here, on the time frame you are on, price closes above, okay, and this is for bullish, okay, a price, a Fibonacci level, look to the next one for a reaction, okay? So this is for a bullish scenario, okay? So when you're the price is bullish and you're looking at a bearish Fibonacci from a bearish point of view, okay? So I'm just going to put here bearish Fibonacci so I don't confuse you. Bearish Fibonacci. Then anytime that happens, then you want to do this, okay? So what would that look like? And I can just put this in blue for you guys. Once I do it once, then don't have to do it again, right? So put this here in blue. Now I'm always trying to use sentences that might be a bit more lengthy, but they will help you to get the gist of what we're looking at here. All right. All right. So now that you have this, if it was a bullish Fibonacci, it would be the opposite. No, my mistake, sorry, guys. This is the, okay, now go right. All right. We're good. It's the opposite way. I think I have two bearish, so I thought it said bullish. My bad. So this is a bullish one here. So bullish. So if we have a bullish candle, okay, or bullish Fibonacci here, then what we want to do right now is anytime on a time frame you are on, price closes above, in this case it would be below. So below a Fibonacci level, look for the reaction, look to the next level for reaction now. Now the key here for each of these, because I missed out a main part, I want to put this in capital so that you don't forget it. It has to be with the body of the candle. And I'm putting this in capital. I know I delayed the middle of this sentence, but I just want you to remember it always. With the body of the candle. And this is something that, again, took me a while to really grasp. It has to be with the body of the candle. All right. With the body of the candle. Now, when I say that, what do I mean? So, for example, if the price wicks above here, so the wick of the candle, which is the high or the low, closes above here. In this case, the high of the candle closes here. With a wick, we shouldn't be so ready to continue looking for the price to go higher because it can reverse. All right. But if the body of the candle closes above here, so if I use an example with some boxes, and forgive me for this example, but let's say this is our H4 candle, and the middle of the body is closed above equilibrium for that H4 session. This is a 4-hour session. Then what you would be looking for is the next nearest level, which is 62. Okay, because at that point, once price closes above here, that means liquidity in the market order book is tipped towards the bullish side of the market. So the price that we should be looking for would be higher, so deeper discount in this case. Same thing if it was a bullish Fibonacci. If we're looking the other direction, all right, when the price is coming back down, and just to put some picture to this, all right, if we say over here, right here, we're going from here to here. All right, so A, all right, B, C, and then D. What would we do? Well, when the price is coming back here, and I'll just draw Fibonacci on my own lines here. All right, so Fibonacci over here. So as the price is coming past equilibrium, if it closes beneath the equilibrium point and is getting lower, we look to the next level for a buy. Okay, so this is what we're looking at. So we do this with our analysis and say on the H4, if the price closes with a H4 candle, so what do I mean by the same time frame? If you've drawn a Fibonacci on the H4 time frame, then you shouldn't be looking for any close of the body that's not the H4. So if we have a H1 candle that closes above here, that doesn't qualify us to not look at equilibrium still yet, because one H1 candle, for example, and this is a good example of some of the mistakes that I've seen students make, is that when they see a H1 close, maybe up here, they say, okay, yeah, let's go for a buy. And they take the opposite side and continue buying to the next level, which is not a great practice to do, because a H4 candle is equal to 4 hours of H1 candles, right? So until the 4th hour or the final round of the 4th hour, before a new H4 candle kind of closes, we could actually see the price come all the way back down again, okay? And there are examples of this across the chart. I'll find some more as we're going along. But you always have to remember that if you're on the H4 time frame, you've drawn your Fibonacci there, you have your supply order blocks on the H4, then you need to be looking for H4 body closes, not H1 or low. Okay. And obviously with the D1 body closes, by the time the H4 has happened, you would have known before a whole daily candle, which is 24 hours or 6 H4 candles, which you may actually be too late to an entry. So what are we looking for? So we can say now that the next retracement entry, which would be where institutional money will be pushing bearish liquidity or supply liquidity into the market, would be either here or either here. So if you see me do an analysis on Friday and I say, okay, we have scenario 1 and scenario 2, if you were to share this with your friends today and show them what you've learned, guys, you would be saying, okay, well, we have 2 scenarios. Either scenario 1 or scenario 2 would be our entry. Now, this is, in summary, the art of analysis. Now, I know it's going to take some time getting used to, and I'm proud of all of you who survived until the 4th lesson and kept on coming and listening to the sessions day after day. Okay, for this is our 4-part series, and I'll be building on top of this. This is just our introductory series onto price mechanism. There's a lot more to cover, but I want to see some trades from you guys because I've given you the entry mechanism to find the trade. Now, to summarize this off, what would be the final trigger we're looking for? Now, remember what we said, okay, before I leave you guys in this session. Now, every time the price is in supply, and I'm going to bring this back over here for you guys to see the writing. Remember the art of entry rules. If we want to buy trade, and what I'm going to do quickly, I'll copy and paste this over here and take it down to our H4 and just leave it down here somewhere. All right. So the art of entry rules, as a recap over here before I end off, is that when we're looking for a buy, as is written here, every time, you should say, now I don't have enough space for it. Okay. So I realized that there's a little bit of a grammatical error there, but you've heard me say it. But every time is what it should say. Every time price forms a swing, all right. Now, if I put time here, it is going to cut off some of the other writing. I think you'll cut off all the blocks. So I'll just cut this out already and make it easier for you guys over here. So if I take this over here, and after I'm going to pull this over right here, supply order block, okay? So every time the price forms a swing high into a supply order block, then we're going to look for a sell, okay? And if it's the vice versa for the other one, if it was for a buy, right? So we'll just rename that. So every time. And of course, that's going to get rid of, okay, not that bad. I just have to put a C and a K. Now with MetaTrader, I will hope they can change this soon, but when it comes to writing, that's one of the things that can be a little bit tricky and annoying, fiddly, but it's fine anyway. So this is it. So every time price forms a swing low into a demand order block, and every time the price forms a swing high into a supply order block. So in this case, we're looking for a sell. Clearly, we are bearish after doing the analysis. So what would we say? So what would be your entry signature? So on this H4 time frame, what you'd be looking for is if price, for example, in our first scenario went into here, first H4 candle formed, then we have another H4 candle form where the high closes above the previous one, but not the body, just the high of the wick. Then the next candle, by the time it's done, okay, the price doesn't give us any more swing highs, price doesn't go above it, then you'd be free to go for taking a sell, right? Then what we'll do if that doesn't work out and price stops you out, and we'll look at on Friday about stop levels and placing stop losses in our Friday session. We'll look for the next area. So in this supply zone area here, if the price went back into this range all the way back up here, then what would we say? Okay, well, if I see a swing high form, I'm going to place a swing. After the swing high forms, I'm going to get in and I'm going to put a sell and put my stop loss above the high. Okay. So whenever it comes to stop loss placement, you're always going to put your stop loss above the high of the swing high. If you're buying, you're always going to put your stop loss beneath the low of the low swing low candle. Okay. And again, guys, here I've laid out the system for you, all right, of price delivery methods, accumulation, expansion, retracement, reversals, in as simple as way as possible that I can make it for all of you who are beginners or intermediate to understand what we're doing here. So I hope you guys really enjoyed this. Please take the time to study. I would like to hear your comments and how this benefited you. And I really do hope you guys enjoyed this. And thank you for staying to the end of the session, and well done. And I'll catch you guys in the next series that I do.